How billionaires are cashing in on Jamaica's next hurricane. Imagine a world where the wealthy don't just survive disasters, they profit from them. Now imagine that disaster striking Jamaica, and instead of global sympathy, some investors are celebrating a financial windfall. This isn't fiction. It's the real story behind catastrophe bonds and how billionaires might be cashing in on Jamaica's next hurricane. The very tools meant to help us recover could be helping them get richer. In 2024, Jamaica signed off on a $150 million catastrophe bond arranged by the World Bank, set to run until 2027. It sounds like a smart move, a financial safety net in case a major hurricane strikes. But the deeper you look, the more troubling questions arise. Who really benefits from this deal? And what happens when disaster strikes, but the money never shows up? In this video, we're diving into the complex and controversial world of catastrophe bonds, financial instruments that turn human misery into high-risk, high-reward bets. You'll learn how they work, why rich investors are flooding into them, and why Jamaica's experiment with cat bonds may not be as secure as it seems.
Had Hurricane Beryl made landfall in Jamaica, i.e. had the center of Hurricane Beryl passed over the landmass of Jamaica, the catastrophe bond would certainly have been triggered. Also, had the intensity of Hurricane Beryl not declined as compared to where it was when it was in the mid-Caribbean, the catastrophe bond would also have triggered under those circumstances.
What exactly are catastrophe bonds? Catastrophe bonds, or cat bonds, are a type of insurance, but for governments. Instead of buying regular insurance from a company, countries like Jamaica go to the global financial market to raise money. Investors put up capital, and if a specific disaster, like a Category 4 hurricane, strikes during the bond period, the country gets a payout, and investors lose their money. If no disaster occurs, the investors get their capital back plus interest. What makes these bonds attractive is the way they're triggered. They're usually parametric, meaning they don't rely on damage assessments, but rather on measurable data like wind speed or storm pressure. That means faster payouts, theoretically within days compared to traditional insurance, which can take months. It's fast, efficient, and sounds like a win-win for developing countries vulnerable to climate shocks. But here's the twist. These bonds are designed to benefit investors first. They carry high yields, in Jamaica's case, 7% annual returns, which is far higher than normal government bonds. That's because they're risky. But for wealthy hedge funds, pension funds, and even insurance-linked securities firms, this is a gold mine. They're betting that disasters won't happen, and when they don't, they make millions. To the ultra-wealthy, cat bonds are like lottery tickets with better odds. They offer massive returns in a world where interest rates have been historically low. If no disaster occurs, these investors walk away with 7% profits on their capital, far more than they'd earn in a U.S. Treasury bond or a corporate note. And even if there is a disaster, the precise conditions that trigger payouts are so narrow, it's often a bet in their favor. Another big reason billionaires love cat bonds? Diversification. These bonds don't move with stock markets. That means while the world burns, their portfolios stay safe, or even grow. It's the same strategy used by some of the largest hedge funds and reinsurers, who see disaster-linked securities as the next frontier of speculative finance. It's disaster capitalism in its purest form. There's also the issue of access. Cat bonds are not for the average person. These are private deals facilitated through institutions like the World Bank and sold in slices to elite financial entities. The structure itself keeps everyday people out, while inviting the rich to bet on the lives of millions. Jamaica's cat bond is now part of this global financial game, with Wall Street players watching hurricane forecasts the way others watch stock charts. In April 2024, Jamaica secured a $150 million catastrophe bond from the World Bank. This was touted as a success story. The Caribbean island was now protected against major named storms from 2024 to 2027. The bond would cover 4 hurricane seasons and trigger a payout if a qualifying storm, based on wind speed and pressure, struck specific geographic zones in the country. The bond uses a parametric model, meaning the payout depends on the physical intensity and location of the storm, not the amount of damage it causes. It's designed to be quick and efficient. If the storm meets the criteria, Jamaica gets up to 100% of the bond value. But if it falls short, even if it causes massive destruction, there is no payout. This is where the controversy begins. For Jamaica, this isn't just a financial experiment. It's a matter of survival. The country has faced multiple billion-dollar storms in recent decades. Without fast funding, disaster recovery slows down, lives are lost, and economic growth stalls. By turning to the cat bond market, Jamaica hoped to take control of its own disaster risk. But in doing so, it also invited billionaires to the table and gave them the opportunity to profit from Jamaica's misfortune. In July 2024, Hurricane Beryl slammed into parts of the Caribbean, causing widespread devastation. Homes were destroyed, lives disrupted, and critical infrastructure in Jamaica took a hit. Citizens braced for government assistance. But when the dust settled, something strange happened. No payout from the cat bond was triggered.
But why?
Because Beryl's central pressure wasn't low enough, and it didn't pass directly through the trigger zones set by the bond contract. This sparked outrage. How could such a destructive storm not qualify for aid that Jamaica had essentially prepaid for? The answer lies in the design of the bond itself, a structure more favorable to investors than to the nation it was meant to protect. Critics called it a betrayal. Activists and journalists pointed to the World Bank and its private partners, questioning whether this was a form of financial exploitation hidden behind the language of resilience. The Beryl incident exposed a flaw known as basis risk, the gap between real-world losses and the bond's trigger requirements. In Jamaica's case, the real damage wasn't enough to satisfy the bond's mathematical formulas. So while people suffered, the investors walked away untouched, still earning 7% returns while Jamaica scrambled to find other funding for recovery.
The catastrophe bond is a risk transfer instrument that allows Jamaica to transfer the fiscal risk of a direct hit by a hurricane to international capital market. International investors put up the principal amount of the bond in the amount of $150 million or just under 24.
Who wins and who loses? At face value, cat bonds look like a mutual benefit. The government gets protection and the investor gets a decent return, unless disaster strikes. But the truth is, the scales are tipped in favor of the investor. The trigger criteria are complex and narrowly defined. In many cases, countries end up paying millions in premiums over the years without ever receiving a payout. For the billionaires and institutions buying in, it's a high-yield bet that rarely pays out in catastrophe. When it does, they absorb the loss, but more often than not, they profit handsomely, while the country walks away empty-handed. Meanwhile, countries like Jamaica may lose twice, once to the storm and once to a financial instrument that failed to deliver when it mattered most. The losers, ultimately, are the people. The Jamaican taxpayer, the rural farmer whose crops are gone, the child whose school collapsed in a storm. They're the ones left behind while global investors treat hurricanes like numbers on a spreadsheet. And as climate change accelerates, these events are becoming more frequent, more intense, and more dangerous, raising the stakes for everyone involved. Should Jamaica renew this bond? With the current bond expiring in 2027, Jamaica will soon face a crucial decision: renew or walk away. Supporters argue that cat bonds are better than nothing, a necessary tool in a world where climate disasters are outpacing government budgets. They point to the speed and efficiency of parametric financing and say the alternative, emergency borrowing, is even worse. But critics say Jamaica needs to renegotiate the terms or look for better options. More flexible disaster financing tools, like blended models or regional funds with lower basis risk, may offer stronger protection. Some argue for domestic resilience building instead, investing in infrastructure, early warning systems, and localized emergency funds that don't rely on international speculation. In the end, the question is not just financial, it's moral. Should Jamaica's disaster resilience be treated like a Wall Street bet? Or should it be rooted in equity, transparency, and true protection for the people? As the next hurricane season looms, Jamaica stands at a crossroads, and the world is watching. Jamaica's cat bond is more than just a financial instrument. It's a window into a larger global system where wealth and risk are unevenly distributed. The country took a bold step to protect itself. But in doing so, it may have unwittingly entered a game it doesn't fully control, a game played by billionaires, hedge funds, and powerful institutions with very different priorities. Whether this gamble pays off or ends in another controversy remains to be seen. But one thing is clear. In the world of catastrophe finance, every storm has two sides, the one that hits the ground and the one that moves the money. Don't forget to like, share, and subscribe for more deep dives into Caribbean economics, politics, and global finance.